Okay, I'm going to challenge your thinking a little bit because at the moment we've got a lot of economic data coming out and we're flashing amber. We've got slower GDP, we've got tariff wars, trade disruptions. And I think in these scenarios, the typical move is to reduce risk. But I think there's an issue that we need to consider, and that is bonds and equities are showing high correlation during these drawdowns. We've got commodities that are being very reactive and cyclical, and we've got real estate, which is illiquid and already facing some valuation concerns. And I think what this does, it limits the effectiveness of traditional diversification in portfolio. And then we start looking at digital assets, especially Bitcoin. They need to be reassessed in their role in a portfolio. I think not as a speculative trade, but as a response to some of the structural constraints that we're seeing, like compressed risk premiums, shrinking liquidity, asset class correlation breakdowns between all the different classes. And I think Bitcoin is behaving like a high volatility, non-yielding position. It's unlike gold, it's programmatic, it's unlike emerging markets because it doesn't have a connection to sovereign default risk, and it's unlike equities because it's not dependent on earning cycles. So it's behaving very differently. And I think understanding where Bitcoin fits in the macro of a portfolio construction is becoming an extremely relevant consideration in the current market cycle.